Imagine investing in something that has a 90% chance of failure and doing it on purpose.
Come on, boy.
That's what VCs do daily, and somehow it just works. It feels crazy or reckless until you understand the math behind it. This video is not about how to invest, it's about why the best investors lean into risk on purpose and make money doing it. But before we start, please consider subscribing. This is a brand new channel I'm publishing here every week behind the scenes of the VC world and Y Combinator. So please give me a subscription. Thank you very much. The most uncomfortable truth that no one talks about on startup investing is that you're going to lose money, and likely you're going to lose a lot of money. And unless you're from another planet, us humans are wired for risk aversion, which means we hate risk and we hate losing, especially losing money. And the metrics are horrible. You're going to lose probably 80 to 90% of the time, and you're going to feel that pain of losing this hard-earned money. I've personally invested in startups that had early traction, an amazing team, startups that actually raised millions of dollars until they went to zero, and all of that money, all of that time, all of that effort was for nothing. And so at this point, you might be asking yourself, why would you ever invest in startups if so many of them fail? That's the whole paradox. It looks insane until you understand the system. Here's how it works. In startup investing, you're not looking for a 10% gain. You're looking for a 100x to 1000x return on your investment. So let's say you're an angel and you invest $10,000 in a startup. You can lose $10,000, but you can also make $10 million. And so that's why you want to invest in several startups and diversify. It's because the math works out only if you play enough hands to catch an outlier. As you've already realized, this $10 million exit can compensate and pay for tens, if not hundreds, of missed investments that go to zero. If you only get one investment that gets to 10 million exit for you, it's all worthwhile and positive in the end. That's the power law in action, which says that very few of your investments, if not only one, will carry the majority of your results. That's why most investors have one or two big exits return their entire funds. That's the purpose and that's the meaning of the famous Jeff Bezos quote around business and the difference with baseball. He says in baseball, when you hit a home run, you can only have a maximum of 12 points and that's it. But in business, when you hit a home run, you could get a $1 billion, $10 billion, $100 billion outcome with what you're building, just like he did for Amazon. And so the winners pay for all the attempts. And so there's a lot of learnings to gather from that. First of all, many investors fall in the trap of trying to chase the winner too early. It takes time for a big outcome like this, and all of the investors obsessed with liquidity who want to exit the company at Series A or B after just 2 or 3 years and make a 3x return on their investment miss the point. Some of those companies could become giants and return 1,000 times their investment if they give them enough time. There's a famous third Apple co-founder who missed out on billions of dollars. Think of poker. When you're folding hands, you want to fold as early as possible so you lose a little. But when you go in very big and you try to win as much as possible. And just like poker and baseball have limited outcomes, in poker you can only win as much money as there is on the table. In startups and in business, you can win even more. And so this is how this whole startup investing makes sense. It's not about being right all the time. It's actually not even being right often. It's about being right once, but at scale and running that wave of that 1 billion, 10 billion plus exit. This is why we investors do this. And so understanding all of that, the trick in startup investing is not to avoid failure, is to embrace it and to build a system that assumes it. And so how do you do that? Well, first of all, you have to make a good number of bets, at least 10, and some VCs go up to 100. So, there's a big margin between 10 and 100. I go for 40 to 50 investments per fund, which is recommended as one of the best number to get the best outcome without too much dilution. Then you have to filter out for potential in terms of the size of the outcome. You shouldn't be afraid of losing money. You should be afraid of missing that big outlier that's going to become a huge exit for you. Finally, don't chase hype. It's very, very likely too late if you're hearing about it now. And last but not least, double down on your winners. Once you've backed, 50, let's say, early investments, very quickly you're going to realize who are the most likely 5, 10 winners. Those are the ones you want to double down on and reinvest in. Most investors think that after you invest, your work is done. First of all, you got to bring value to the startup. I've talked about that in another video, but also you've got to stay alert to figure out as quickly as possible who the big winners are going to be if you want to pile on more money onto them. Remember, founders only get one shot at their company, and of course, they can start another one later, but in your fund or in your portfolio, you get several shots, many of them, so use that to your advantage. After having said all of that and understood the math, I'm still trying to reduce my risk because the less companies from my portfolio fail, the more likely they are to become a great outcome and have a big exit. And so that's why I choose to only invest in YC startups. Y Combinator accepts less than 1% of applicants and attracts the most talented founders in the world. And so by only investing in a pre-selected cohorts of startups, my risk goes down significantly because it gives me a much higher quality pipe or source. What's interesting is even at YC, which is considered the best startup incubator in the world, the failure rate is at least 50%, which seems still very high, much lower than the 90% out there, but even if you're investing on YC, you should expect a high failure rate. Obviously, another thing that's interesting with YC is that 25% of the unicorns out of YC actually end up becoming decacorns, startups valued more than 10 billion. So 1 out of 4 unicorns becomes a decacorn, which means your returns 10x if you go from a 1 billion exit to a 10 billion exit. But again, don't forget, 50% are gonna fail, and you have to expect that. So the truth is, this game is really hard. Some people just can't stomach the failures and losing so much money, they give up too early, or they become too emotionally invested in an early winner that then doesn't make it and they're crushed. So you have to keep your emotions in check, and you have to understand the system, and you have to understand the game you're playing. And by the way, this is human nature. It's ingrained in our brains. There's been a study where you flip a coin, and if you win $100, but if you lose, you have to pay $50. And so because your odds are 50-50, then the hope of gains overall of that challenge is positive. You should play that game because your hopes of making money are superior. But it's been found that most people would rather not play because they're too afraid of landing on the wrong side of the bet and actually having to give the $50, even though if you're perfectly rational, you should play because it's in your favor. And so this proves that we want to avoid pain or negativity more than we're attracted to gain. So this is in our DNA, in our nature. And so investing effectively requires that you go against your emotions and against your first intuition. That's why I don't invest casually. I've been investing in startups for more than 12 years, and I've not only learned to keep my emotions in check, but built a very, very strong system with some very specific criteria to filter out the noise from the rest and invest at the right place at the right time. It's taken me years to get there with a lot of experience, sometimes the hard way, I'm not gonna lie. And I've also been able to build amazing relationships along the way, to have peers just, whispering in my ear and exchanging, comparing notes to see where we're going and not advance blindly. But if you're alone, if you're an angel investor, if you're not doing this full time, it is much, much, much harder. My advice to you would be to partner up with someone at least doing this full time and at least with several years of experience. I've seen countless angels invest randomly without having built a strong network, and just get burned doing so. If this sounds like your kind of game and you want to become better at it, you can subscribe to my newsletter. The link is in the description. And if you're new to this channel and you like this video, check out my video on portfolio construction, which I'm sure you're gonna love. Thank you so much for watching. Please consider subscribing. See you next time.